Welcome back to Financial Fortitude, the podcast where we help high earners, families, and business owners balance living well today while planning for tomorrow. I'm Michael Acosta, joined by my co-host, Brady Hemmerly.
Today's episode unpacks a tool that's often misunderstood but increasingly used by high net worth investors, the Securities-Backed Line of Credit, or otherwise known as an SBLOC. It's pitched as a flexible, low-interest borrowing tool for those with investment portfolios, but is it a smart move or a slippery slope?
We'll explore what SBLOCs are, how they work, and when they can be a strategic move versus a red flag for your financial plan. Welcome to Financial Fortitude, a podcast for high earners, families, and business owners. We are your hosts, Michael Acosta
and Brady Hemmerly. Each week, we bring purpose-driven financial guidance to you so you can be assured you're on the right path. If you're looking to become an extraordinary wealth builder, let's dive in. Michael, I am quite excited to talk about today's episode because I think this is a topic that we are employing, seeing, getting more and more questions from our clients on, and I think a strategy that is oftentimes not really mainstream. It's not something clients are asking of us all of the time.
Yeah, it's not something that's often brought to our attention by the client. It's more of us putting it in front of them as a strategic idea that they otherwise weren't aware of, right? Either, just because they haven't had the time to do the research, or the advisory firms that they were working with previously did not have access to this type of solution or strategy within their wheelhouse.
So let's talk first, what actually is an SBLOC and how might you compare it to other financial vehicles or tools that clients may or may not be more familiar with?
Yeah, so I'm going to refer to Investopedia's page on Securities-Backed Line of Credits and give you their example. So a Securities-Backed Line of Credit is, in simplest terms, a line of credit that you are associating with your non-retirement investable assets. So another formal way of saying that is a line of credit against your non-qualified assets, right? Think of a brokerage account, either in your individual name, or maybe it's a joint account that's held between you and your spouse, or it can be a non-qualified brokerage account that's in the name of a trust. And so these are typically known as taxable investments, meaning taxable in the sense that after-tax dollars, and whenever you buy and sell, it can trigger some sort of tax liability to some extent. And so you cannot set up securities-backed line of credits with retirement accounts such as Roth IRAs, traditional IRAs, rollover IRAs, or 401ks. That would be something totally different within the realm of a 401k. But for this specific conversation, it's more or less tapping your investments with a line of credit to gain access to capital, access to money, very similar to a home equity line of credit with your home, without triggering any sort of tax liability by having to go and sell some of your investments, give up control of those holdings that you might have in that account.
So, Michael, if we, take a quick step back and are talking about a home equity line of credit, a little more familiar with many clients that we work with, what is it? Why would someone use it?
Yeah, great question. So home equity line of credit, also known as a HELOC, is very similar to the securities-backed line of credit. The biggest difference, though, is that you're going to be tapping into the equity in your home without having to actually go and sell your home. Traditionally, if you're not going to have a HELOC or a home equity line of credit, the only way to get access to the money you've made off of your home purchase would be to put it on the market and wait however many days, 30, 60, 90 plus days, for a transaction to occur, and then you receive the net proceeds from the sale of the home, right? Another way of looking at the equity or of calculating that is taking what your home is valued at today and subtracting out the outstanding mortgage balance. The difference between the two is going to give you the equity in the home that you've become the benefactor of, either just because the home's appreciated over time or because you've been actively paying down that mortgage more aggressively than just the traditional amortization schedule. Now, the reason why people set up home equity lines of credit, in my opinion, and the reason why we recommend or encourage clients to do so from a planning perspective, is to just have an extra emergency fund. So specific to the HELOC, the equity in the home doesn't really do you any good while you're living in the home unless you're going to leverage it, right? Whether you're leveraging it for a renovation, whether you're putting a covered patio in the backyard, whether the HVAC in your home goes out, whether you're driving and the transmission goes out on your car and you need access to capital. So it's more or less just a quicker way, I won't say quick, but quicker way of gaining access to the money you've made on your home purchase so that you can utilize it in other areas of your balance sheet, typically at an attractive interest rate, but it's going to be variable for most instances.
So effectively, a home equity line of credit is simply a tool to gain access to your money without actually selling the underlying asset, which is your home.
Correct. Yep. You maintain control of the asset, the home in that instance, in exchange for, access to the capital while paying a little bit of interest.
Yes. So securities-backed line of credit for all of our listeners is effectively quite similar. The only difference is rather than the asset being the home that you live in, the asset is just simply your brokerage account.
Correct. Yep. And in that brokerage account, it could be any combination of individual stocks, ETFs, or even mutual funds, or really bonds for that matter.
So how does the securities-backed line of credit actually work and perhaps compared to the home equity line of credit? How do I set it up? What access do I have? Like, how much different is it?
Yeah, so I would say the setup is probably the biggest difference in that if you're going to go set up a home equity line of credit, you're typically going to go to a bank or a credit union or a specific lender that offers that type of tool within their wheelhouse, and you will likely need to pay closing costs, right? Very similar to what you did when you closed on your home for the mortgage, and potentially even an appraisal, which might cost you a couple $1,000s, aside from needing to actually own a home in order to set this up. And if you haven't, bit the bullet and purchased a home yet, go back and listen to one of our last episodes. I believe it's episode 24, where we talk about renting versus buying, and you can hear a great debate between Brady and I as to where we stand on which path we think makes the most sense. But again, you have to actually own a home in order to have a home equity line of credit. Now, with the securities-backed line of credit, very similarly, you need to actually have a brokerage account or an individual account that has assets in it. Typically, there's going to be some sort of minimum balance requirement in order to get access to this type of strategy. But the underwriting process is going to be a little bit different in that there's really no cost to you other than completing the application itself and allowing the provider to do a little bit of financial underwriting on you and or your spouse or the trust, depending on where the account is actually registered and held.
So Michael, at this stage, if I'm a client, I own a home, I have the ability to go out and get a home equity line of credit. I just have to go to the bank, go through underwriting, perhaps pay some costs. I also have a brokerage account. Let's say it's got, for simple math, $100,000 into it. I can simply go to my financial advisor, the firm that I'm working with or that I custodian assets at, and ask to set up a securities-backed line of credit. They may pull some basic information on me and my spouse, do some due diligence, but big picture, it's not nearly as intrusive or there aren't nearly as many steps to walk through to get it set up. So once I have the line set up, what does it look like? How does it work? How can I use it now that it's there?
Yeah, one thing that we overlooked is that typically, and this is very similar to a home equity line of credit as well, is that you're only going to be approved for a line of credit up to a certain percentage of the overall asset value. From a home equity line of credit standpoint, it's the debt or value of the home to the outstanding mortgage ratio. And for the securities-backed line of credit, it's going to be somewhere between 70 to 85% of the account value. So we're using the example of $100,000 just to say it's 80% of the asset value. So that means that we have access to about $80,000 in liquidity that we could tap into without having to give up any control over our investments. And so how this actually functions is no different than just having a line of credit in general. You don't actually pay any interest until you start using it. And when you do use it, you're only going to pay interest on the line of credit that's outstanding. Now, what's really neat about a securities-backed line of credit is that there's no term for which the outstanding line of credit that's been used needs to be repaid. Like there's no timeline. If I go get a home equity line of credit, it's either going to be 10, 12, 15 years. In some instances, I think I've seen as far as 20 years as far as repayment term. And so you have a little bit greater flexibility with the securities-backed line of credit because you can keep a line of credit outstanding until perpetuity, right? Until you pass away. And we're going to talk about the tax and estate planning aspects of this as well, as far as having a line of credit. Now, as far as the interest is typically going to be variable on these types of products, these types of solutions, which can be beneficial if you're in a lower interest rate environment compared to a higher interest rate environment. But even still, you have to go through the exercise of calculating, okay, well, what is the net opportunity cost here of me getting access to this capital for any sort of use case in my life, right, from a financial planning perspective, versus me selling the investment and understanding what the tax liability ramifications might be. Think about if you had low basis stock. Let's say that you had purchased a tech stock 5-10 years ago and you got in, when it was trading at, let's call it $36 a share. Now it's trading at $200 a share. That's a pretty significant gain. That's, close to $170 gain per share. So if you were to go and sell some of that, you're going to pay, long-term capital gains, which is going to be 0, 15, or 20%, depending on your overall household income. If you did that over a shorter period of time, right? If you just picked the right stock and it took off from the moment you bought it in less than a year and you sell it, well, now you're going to pay ordinary income taxes. So to bypass any of that tax ramification or that tax liability altogether, what you would do is you would just borrow against the stocks.
So in that case, I've got $100,000 in the account. I've got, call it an $80,000 line, and I get a surprise or an emergency and my car goes out. I need $20,000 to buy a new car. In that case, let's say I don't own a home. I'm a renter, at least if you go back and listen to the other episode. I don't own a home, so I don't have a line of credit to tap there. My only option in this particular case is my brokerage account. And now I have two options if I've set up the line of credit. I can either sell shares of stock or tap into the equity line that I've now got set up, $20,000 of the $80,000 that's there. And what we are sharing oftentimes with clients is that, hey, before jumping straight to the typical solution of just selling the investments that I need and cashing a check, I could go in and take the money from the equity line, preserve the investments that I have in my portfolio, essentially sidestep the tax implication of getting that money. And now I've got $20,000 in my hands to purchase the car and a $20,000 loan that I owe back to my brokerage account, but with no term attached to it.
Correct. And this wasn't really a part of today's conversation or plan, but because you brought it up, I can't leave it out there, right? You kind of given me the assist here. But if you really want to maximize that situation, I would say if you're an avid credit card user, pay the $20,000 on the credit card, get access to the Securities-Backed Line of Credit, pay the credit card off. So now you have the reward points.
Sure.
And, you just added an extra layer to optimize that decision-making process. But no, yeah, that's exactly how it would work. And so one thing we haven't talked about is when you're making the payments back to the Securities-Backed Line of Credit, and for that matter, a home equity line of credit, you can make interest-only payments, right? So specific to the home equity line of credit, you can make interest-only payments until the balloon payment is due, whether it's 10 years, 12 years, 15 years, 20 years. And all I really mean by balloon payment is that, hey, if you wanted, let's just say you borrowed $20,000 and you're paying interest and you're just making interest-only payments for 10 years, and then the line of credit matures in year 10. Well, now when it matures, you're responsible for paying whatever remaining balance is due. In that case, you've only been paying interest only, so 20 grand is due.
Yep.
Right? With the Securities-Backed Line of Credit, there's no maturity date. So you can make the interest-only payments until perpetuity, right? You can carry that until your toes up in the grave, and then it becomes the problem of the estate or the trust or your heirs to be able to solve how that outstanding line of credit gets addressed.
So let's pause there then. So let's say I've taken my line of credit out. I now have $20,000 essentially against my brokerage account that I owe, but just simply without a maturity date. I've decided for my situation that I'm going to pay interest only for the time being. And then I look at my account and my line of credit next quarter. If I'm only paying interest on the account, I'll expect right around $20,000 to be there as the line of credit, just depending on when I've made the payment. And let's say the market and all of my stocks have increased by 10%. Where does that leave me, or what does that look like in that instance?
So where that leaves you is that if your stocks, your investments have increased by, you said 10%, correct?
Mm-hmm.
Then now your investment account balance is higher, but your line of credit is still static at 20 grand. Now you have a couple options here. If you've been receiving dividends and interest because you own dividend paying stocks, well, now we can leverage those dividend paying stocks to actually pay back that line of credit for you if you would like, whether it's an interest only payment or whether it's interest plus principal. So you can start to leverage the use of those investments even further now, aside from just leveraging it for access to capital. You can now leverage the utility of its growth. You could even increase your access of line of credit because now the portfolio value is higher. So now that means you have a little bit more quote unquote equity in the portfolio that you could borrow against. And going back to another scenario, if you have 10% more in your portfolio, well, now if you wanted to, you could technically sell $10,000 of your investments and utilize that to cut your loan balance in half, which should effectively cut the interest in half as well that's due. So again, all we're looking for here is the utmost flexibility in our decision-making process or the opportunity to quote unquote survive in advance. Now, is this the best use of, the solution or the strategy if we have ample cash on the sideline? Yes or no? I guess it just depends on the other goals that you have outlined for, the short term or midterm, if that makes sense.
Yep. And I think where the real advantage is for many clients is just retaining control of your investments, right? Every time that one of our clients goes in and sells an investment to raise and then withdraw cash, that's $10,000, $20,000 less that they have still growing or having the opportunity to grow for them in their portfolio, because it's now being completely allocated to another source.
Right. And the compounding effect of interest and dividends growing over time is very powerful. But if you continue to take air out of the growth, then you're starting back from scratch all over again. And you could be starting over from scratch during a period of time where it's less desirable, meaning that, you started before the market went on a bull run, and now you're starting over where we're at all-time historical highs. And it's like, okay, well, is there another run in the foreseeable future nearby for me to get exponential growth in compounding interest again? Now, one thing we haven't talked about is the overall risks. What are some of the risks or cons of using a securities-backed line of credit, Brady?
So yeah, up to this point, that was going to be one of my questions for you too, is it sounds too good to be true, right? Like, hey, I can pay interest only on a loan, get cash right away, and my portfolio will continue to grow and I'll build more and more equity in my account. So I'd say biggest risk of using an SBLOC, and it's a similar risk to using a home equity line of credit, although the home that you live in, generally the value of that asset is pretty stable. You may wake up tomorrow, the value of your home may not change significantly or at all. But in your brokerage account, what we all know is that there can be a lot of volatility or loss in the stock market. And as your portfolio is going up and down, it begins to squeeze how much available equity that you have against your brokerage account. And this is where, when we talk through the risks of using a securities-backed line of credit, what we call a margin call. Right? Example being here is if I've got a $100,000 brokerage account and I take out the largest line possible. Now instead of $20,000, I'm taking $80,000. So I've only got $20,000 left in equity in my brokerage account. If next quarter, instead of my portfolio going up 10%, my portfolio is now down 10%, I'm going to get a call or a push notification from the line of credit essentially saying, hey, we're underwater on how much available equity is in the account, and you have to step in and put more money against the line to avoid effectively selling all of your investments and clearing the line before the risk is there.
Right.
Because the true risk is, hey, I've taken out a line of credit and my investments now go below the actual line of credit. I have negative equity sitting in my portfolio.
Gotcha.
And those margin calls can put additional pressure on the brokerage account. It can put additional pressure on other assets that you have. And just as if we were to take a withdrawal from the account, a large margin call can effectively lead to a large unforeseen tax bill.
And again, when you feel like your back's in the corner, you start to lose options as far as how you can address the concern. And so in this instance, if the portfolio value drops too much because you took out too large of a, or you used up too large of a line of credit. So again, you had a $100,000 line of credit and you decide that you want to use the full amount, right? Whatever amount you might want to, and the portfolio value dips because of market turbulence, then that's where you have very limited options to get out of that, right? Other than maybe putting money in the account or selling some of the investments to offset that.
So Michael, if one of the biggest risks of the SBLOC is margin call, volatility risk, right? Having limited options if too large of a line is taken out, what other risks are worth considering, or what else is out there as a potential con?
Yeah, I'd say one of the other big cons that we've lightly touched on up to this point is the fact that traditionally the interest rate is going to be variable. Now, the difference in interest rate is that, in comparison to a home equity line of credit, is that more often than not, at least with the vendor that we use for our securities-backed line of credit, they're not using the prime rate. They're using the SOFR rate, which is tracked differently and it's a different amount. So right now, if we were to look at the cmegroup.com website where they will post the 1 month SOFR rate right now over a 1 month period is 4.32229% as an example. Well, usually there's going to be some sort of premium attached to that. So home equity line of credit might be prime plus 1 or prime plus 2. So whatever the prime rate is plus another 1 to 2% on top. Whereas the SOFR, at least with the provider that we leverage, the smallest line of credit that we can actually set up is going to be at $26,000. So for that, it's the SOFR rate, again, 4.32 and some change, plus 2.9%. So you're coming in at 7.22%. Now, one of the benefits is that as the account value grows over time and that line of credit increases over time, you start to get discounts or you start to break into different tiers where you get break points on the premium that you're paying on top of the SOFR rate. So a line of credit of $500,000 to just under $1 million is going to be SOFR, again, 4.32 and some change, plus 2.4%. So now we're sitting at less than 7% in that variable rate. Now, again, this will shift. So about a year ago when we were in a higher interest rate environment, that premium would have been a little bit higher. The SOFR rate might have been a little bit higher. If we go back to 2020, 2021, those rates would have been a little bit lower. So there's pros and cons to it and things that you just have to be aware of when measuring the cost of using these dollars as opposed to just using the money in your pocket.
Yeah, cash outside or just selling the investments as is and taking the cash.
Correct. And then calculating whatever sort of tax liability might be tied to that.
Yes. Yep. So I guess as we begin to wrap things up here, where do you see the most common use cases for an SBLOC? If I'm a client out there listening to the episode and I'm saying, okay, this sounds great, leveraging my brokerage account without some of the taxes and with some more flexibility, like when would I use it?
In most of our client engagements, as we're guiding them through our triage process and our treatment plan, it's setting it up just to have as a secondary emergency fund, right? If they don't have a home equity line of credit, or maybe having both a home equity line of credit and a securities-backed line of credit on top of an emergency fund, right? Having access to capital is not a bad thing, especially if it's not costing you anything to keep it on the books because you're not using it yet.
Yeah, you're just building a moat and you're doing it for free, right?
Exactly. Exactly. Aside from the home equity line of credit where you might have closing costs and appraisal fees, right? But with the securities-backed line of credit, I have clients that have used it for down payments on purchasing primary residence, down payment on purchasing short-term beach rentals, access to be able to purchase a new car, as well as access to the capital for a buy-in to a medical practice. And what's nice about this is that as we start to assess whether or not it makes sense to sell some of the investments and take the hit on their investment portfolio or eat the tax liability that might be associated with, some of the growth that the clients have experienced when making these decisions, we shift the portfolio integrity some so that it's more interest and dividend focused as opposed to just capital appreciation and growth oriented. And the reason why we do that is because we want to be able to leverage this idea that I love known as velocity of money. How many times can I leverage the same dollar over and over again, maximize its use for my own benefit without giving up control of it? So again, I might be able to fit within my budget making that interest only payment, but now because of the dividends and interest that I'm receiving on a monthly or quarterly or semi-annual or annual basis, I can start to accumulate those in cash and make extra payments towards my securities-backed line of credit that's outstanding, right? And that's not coming out of my cash flow, my working capital, my working effort. That's just coming from the utilization of my assets and me just being more efficient.
Yeah, without giving up those assets either, right? They still continue to pay or spit out those dividends every month to pay the loan down without you actually selling them to generate the capital to do it.
Right. And if it's not going to push me into paying more taxes because I'm not giving up, because I'm not selling at a high, right? Because I have significant growth or because I have low basis in these stocks, then why not?
So I guess that's a good transition to the other opportunity where I see clients use SBLOCs, right? You've mentioned cars, medical practices, second homes. I think oftentimes where we see the true use of an SBLOC as a moat around your financial fortress, right, is during periods of market volatility. If I'm a client who's collecting income or if I'm a client who is going to use a piece of my brokerage account for a goal, and I see over 1 or 2 quarters the market go down by 10, 12, 15%, in order to gain access to that capital, I now have to sell at a loss, or at least a loss compared to all-time high. But what I could do instead is take a small piece of my securities-backed line of credit. Hey, instead of take out $20,000 from my portfolio when the market's down, I can just lend against my portfolio for the $20,000 and then wait next quarter thereafter into the following year for my portfolio to rebound. And at that time, I then have options, right? I can use that rebound in the portfolio to take the withdrawal that I otherwise would have, or I could use that rebound in the portfolio and those interest and dividends that we've set up to effectively just pay down the line faster than what otherwise would have been. So it's just a tool to hedge against market volatility and hedge against potential taxes in those instances if I was to sell instead.
No, I love that. And the reason why we guide clients down that path, again, as a way to preserve assets in the best of our ability, is because, and you hadn't touched on this yet, so I want to go a little bit deeper on this as an opportunity. But if the market's down 10% and I'm also withdrawing 4%, how much did my portfolio value just decrease?
14%,
right? Yeah.
Trick question, not quite.
And so, the value of your assets can get depleted rather quickly during a bear market or a downward market, right? And we try to explain this to all of our clients. When you step into the arena of investing in the stock market, either within the US or globally, you're exposing yourself or you're accepting the opportunity for turbulence, market turmoil, volatility to occur. All right, no difference than when I get on a plane. And everyone knows that's been listening to these episodes that I despise flying. And it's primarily because of the turbulence, right? I don't have any control over it and I just don't like it. And so if I'm going to fly from the East Coast to the West Coast, I've already baked into my mind that, hey, there's going to be turbulence. I just don't know when. I don't know how long it's going to last. And I don't know how volatile it's going to be. Hopefully very little, if any at all. But again, it's the same concept when we invest. So why not create other safeguards or other opportunities within your financial plan that says, hey, when the market's down during a year of retirement where I'm living off of my assets, instead of creating additional emotion or anxiety with seeing my portfolio value drop not just 10% because of the market turbulence, but 14% because of the 4% that I took out on top, having that bucket of liquidity through the form of a home equity line of credit, securities-backed line of credit, or even cash value life insurance can be powerful, or even just a high yield savings account. It's the idea of just having access to the capital that provides the utmost flexibility in making decisions.
All right. As we begin to wrap our episode here, some of the key highlights, and feel free to jump in to add color as needed, but some of the key highlights of an SBLOC. First and foremost, it is simply a line of credit that gives you access to cash, but rather than being tied to your home, it's tied simply to your brokerage account.
Correct.
Individual, joint, trust. The SBLOC can be used as a tool to gain access to capital, and typically it comes with a variable interest rate. And on top of that variable interest rate, also some potential risks, knowing that the asset, the investments that are tied to the portfolio, can be volatile.
Correct.
So our encouragement, or in summary, we think that an SBLOC is a very important tool to have to build a better or more comprehensive financial moat. And it's a very important tool to consider using to continue to push your dollar to that next level in that velocity of money concept.
Right. And I would say before making any decision around implementing, applying for one, you first need to figure out where I have my assets. Do they even offer this? Because not every place where you invest is going to offer access to a securities-backed line of credit. Separately, before making this type of decision, you should go out and speak directly with your financial advisor and or CPA or tax planning professional to just make sure that you're not overlooking any sort of tax situations or planning situations that we may not have addressed directly or gave greater insights into. So if you don't have a financial advisor, then that's where you could obviously reach out to us, and we'd be more than happy to have a conversation with you to help you discern whether or not a securities-backed line of credit makes most sense for you and your financial plan.
Thanks for joining us today on Financial Fortitude. If you've been pitched an SBLOC or are wondering if one belongs in your toolkit, We hope this episode helped clarify both the opportunities and the risks.
As always, subscribe, leave a review, and share this with someone who's managing a growing investment portfolio and needs smart, tax-aware liquidity strategies. You can also submit your questions at www.genesiswealthplanning.com/AMA, and you may be featured on one of our future episodes.
Thank you for joining us this week on the Financial Fortitude Podcast. We hope you enjoyed the show and learned something along the way.
If you're looking for financial guidance that is personalized to your specific needs, we're here to help. Visit us at www.genesiswealthplanning.com to book a complimentary consultation.
That's it for today. Make sure you subscribe so you don't miss out on future episodes. And as always, please share with others you feel could benefit from the show. See you next time.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Genesis Wealth Planning LLC, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. All scenarios and names mentioned herein are purely fictional and have been created solely for educational purposes. Any resemblance to existing situations, persons, or fictional characters is coincidental. The information presented should not be used as the basis for any specific investment advice. Michael Acosta and Brady are registered representatives and financial advisors of Park Avenue Securities, LLC, PAS. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Consolidated Planning Group, Inc. and Genesis Wealth Planning, LLC are not affiliates or subsidiaries of Park Avenue Securities or Guardian. Michael Acosta's California Insurance License Number 0M50974 and Brady Hammerly's California Insurance License Number 4353077. 7237198.12, expiration 827.